So I think it's always good to have bonds in your portfolio. I wouldn't buy bonds. I'd buy treasuries because if things do go bad, the one thing that tends
you
to
can get your money back, but
well, you get your money back.
2.8, still do it?
Well, the thing is, you have to think about like, what is it doing to your portfolio? And so if we get a risk off of it and something happens and you go from 2.8 to 2.5 or 2.4 or 2%, that gives you ballast in your portfolio to offset what you might lose for equities. And given we're at 2.8, I mean, it's not a great return, but compared to what it was before, now you get a little bit of money at least on your cash. So it gives you that defensive protection, and it's not costing you as much.
So what exactly are you recommending? How much cash right now would you say?
It depends on the investor. I mean, we always advise clients to have essentially enough cash on hand or liquid assets to cover their expenses for about 3 years. And then you go beyond that, well, then you're thinking about what is your long-term strategy? How do you want to invest in that? And that really becomes down to how much equity risk you're willing to take. And there it could be substantial equity allocation. It really depends on how close to your retirement, things of that sort.
Deborah, I hear this a lot. One of your quotes is that finally fixed income market participants are back in the game. They're back in the game because they finally have something because rates are above zero. I mean, really? I mean, I know you've been waiting a long time to get back to here, but should I be excited about what I can get with either short-term equivalents or bonds right now? Or I guess if bonds are going up, it doesn't matter if they're going up from low levels, they're still going to be positive.
That's correct. I mean, in our estimation, we'll continue to see them going up for the rest of this year and into 2019, despite some discussions in the market, potentially otherwise. And it's better than zero. We're approaching 2.5%, depending upon what your duration is in those short-term securities, and likely to continue rising as we go forward. So
as far as you do have opinions on stocks, you think we're in the seventh inning stretch. Is that a fair description? So what does that mean? We're singing the Take Me Out to the Ball Game, but then the bottom of the seventh, and we'll have the bottom of the seventh, and then the eighth and the ninth, and no extra innings. Is that about right?
We're not looking for extra innings at this point, but it's a long game, no matter whether you're in just regulation time or extra innings. We have drawn back. We're still overweight our equity position, but we have drawn back a little bit. We're also overweight credit in our fixed income position. So, both of those lead for an outlook that continues to be an economy growing at a fairly steady pace. From a duration standpoint, we're a little bit shorter, just given what's been happening from a yield curve and our expectations for rates.
So, I mean, if I was sitting at home, I'm not sure. I guess I just stay where I am, basically. Nothing's really changed recently.
Not much. I mean, like, you want to stay invested. The outlook for the U.S. economy and the global economy is still really good. Whether we're seventh inning stretch or not, that's hard to say, but we're probably past the midpoint of the cycle. But there's no signs that this is coming to an end in the next 12 months, probably even before the end of 2019, and it could go on a lot longer than that. So the worst thing you can do is to try and get too concerned, too cautious, and sit out. It's better to be invested than to kind of be on the side.
Jason, one of the areas that seems like it might be a decision point here is U.S. versus the rest of the world. You've really seen this huge divergence recently in terms of how the markets have behaved. And, of course, the economies have also diverged a little bit, but I wonder if the markets now present a little bit of an opportunity.
So the past 3 months, the divergence you've seen between the U.S. and ex-U.S. equities has probably been one of the most extreme in history, which means, one, we'll probably get some kind of just general mean reversion. Some of the factors that behind that strong dollar likely to abate a little bit. The big movement in rates we've seen this year is probably already played out. And the big, to me, kind of the question mark is how does the tariff and trade situation play out? If this escalates, I think that's again bad for the rest of the world. If it doesn't, then I think you have an opportunity for the rest of the world to catch up.
Let me ask you about China, because that's the big trade dispute. Also, their stimulus, they seem to be trying to keep their markets alive. But if China starts to recede, if it really goes into a problematic economy, how bad is that for us?
So it's obviously an indirect effect because China is some of the biggest marginal contributor to global growth. So they're a smaller economy, but they grow faster. So if they start to slow, that impacts Asia, it impacts the global economy. The U.S. is a relatively closed economy, so we'd be somewhat immune, but we're not going to be completely unaffected. So what China does in the trade negotiations, to me in the near term, that's probably one of the biggest kind of question marks. Do they kind of bring something more to the table, or do they still have a hard line?